Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 335 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including the latest Bloomberg Business Week Scary magazine cover, what's driven stock prices for the past 6 years, illiquid investments, earnings season, 2026 potential interest rate cuts, and a discussion with Taylor Ledbetter for the financial planning topic of the week. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. So good morning, Matt.
Good morning, Mark. How's January treating you?
Good. About to get pretty cold here and snowy, it seems like, in the Dayton area over the next couple of days. But other than that, everything is good.
Yeah, everyone's talking about the storm coming in, right?
Yeah.
Across the Midwest. I'll share a quick story with you. I was at the local grocery market over this past week and saw one of my neighbors, and this neighbor obviously knows what I do for a living. She looked at me and she's like, "Matt, how are you just sleeping at night? How are you keeping up on everything that's going on in the market?" I looked at her and I go, "I'm sleeping like a baby right now."
Yeah, that's we've had stressful times in our business, but this right now is not one of them.
It kind of seems like normal. You're going to continue to have, scary headlines that make people risk apprehensive about the markets. That's always going to happen.
Yeah, and I think that we're I don't know what the best way to say this is, but we're kind of like separated from that because we don't make investment decisions based on news headlines and that type of thing.
Well said.
So
Yeah.
it's just like when we see it, it's just kind of like, oh, on to the next thing.
Or another data point I need to consider over time.
We don't like sit there and stir over it.
Yeah, like brash
and
decisions
start
the next day.
Right,
Yeah.
right. So
I just think some people assume that outside our industry.
Yeah, agreed.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Moving on to pricing for this week. So all of this data I'm about to share is from Y-Charts and as of the market close on January 21st. S&P 500 index is up 0.4% for the month and obviously the same for the year. Dow Jones Industrial Average up 2.1% in January. The NASDAQ Composite Index down 0.1% for the month. And the Russell 2000 Small Cap Index, being the strongest of the year so far, up 8.8% to start the year. And then the Vanguard All World X United States ETF is up 4.2% for January. 3-month Treasury rate at 3.7%, the 2-year Treasury rate at 3.6%, the 10-year Treasury rate at 4.26%. So yields creeping up a little bit over the past couple of weeks. And one of the things that I've found to be interesting is, the Fed is cutting rates right now, which in my opinion is like, okay, inflation isn't too much of a concern right now. But the yield on the U.S. 30-year Treasury continues to climb pretty steadily, which to me, reading that, it's like, okay, maybe the bond market thinks that inflation really isn't over yet. So I don't know if you have any thoughts on that.
I think it's a good question to throw out there. First, I think it is less the inflation question and more that the country is going to continue to borrow money. And there's concerns what that might look like in 10, 15, 30 years in your example, right? Yeah. I think what's also kind of interesting over the past couple of weeks, the mainstream media, and I know you're going to get to this here in a second, was blaming the uncertainty regarding the administration in Greenland. In my opinion, that's not what's going on in the market. It has to do with what's going over in Japan, right? And this is a rinse and repeat topic over the last couple of years. Every time their market comes under pressure, in a very simplistic example, listeners and viewers, people are borrowing at low interest rates in Japan and they're buying securities outside the country. And when the collateral goes against them, they're forced to unwind that leverage. And I think that's just the broader pressure you've seen in the market over the past couple of weeks. But I'm going to go back to a classic Mark McEvely statement. It's not the things that the market is aware of that tends to derail it. It tends to be things that we are not talking about right now at this moment. Hence, when I saw that, it's like, okay, this has been pretty widely telegraphed. Doesn't mean it's not going to cause some short-term pain.
Right.
But in my opinion, that's not new to the market.
Yeah.
Is it a good way of saying it, Mark?
Yeah, for sure. So yeah, I saw that the other day as well. And, you know, over the past couple of days, obviously, it's been a little volatile. And
Sure.
A lot of people attributing that to the Trump administration's talk on trying to acquire Greenland. You know, but again, there was this thing going on behind the scenes with Japan, which we've seen before, which some people think was the major catalyst. But for our purposes and our work, it doesn't really matter what the news event is. It's just this is what happened in the markets over the past couple of days.
Yeah, I do think it's kind of funny how the headlines were largest down day in the market since October. You know, I'm not saying it was a little bit of pandemonium, but it's just interesting how we are in a lower volatility environment, and all of a sudden you have a day like that, and people are like, oh, "Is this the beginning?" And it's like, this is normal.
Yeah, I think Charlie Bilello, and this wasn't a part of what I had prepared for today. I think I read it last night or 2 nights ago. I think he said that on average there are greater than 2% down days on average, like 29 times throughout the year. So it's, again, this is not something that, you know, people should be throwing their hands up and getting all in a tizzy about.
Just hasn't happened as
yeah.
often recently, right?
Right.
Recency bias.
Right. Moving on to tweets, articles, research from this week. The first thing I had was Bloomberg Business Week's latest magazine cover, and this was for January of this year. And Jenna will throw this up on the YouTube video. It'll also be in our show notes. But essentially, what it is a big bubble on the front cover, and it says "Beware the bubble: How to Survive the Year Ahead," and it has like a little pin at the bottom of it there. So for people that might not be totally familiar with this terminology, a stock market bubble is when prices rise far beyond what a company or an asset is actually worth, right? Mostly because people expect prices to keep going up, not because the fundamentals justify it. It's kind of more driven by emotion and hype rather than earnings and cash flow or long-term value. So when expectations break, the bubble, quote, pops and prices kind of snap back toward reality. And the biggest problem I have with this is I feel like every single year that I've been in the industry, there's been a number of people saying out there that we're in a bubble, right?
Keep going.
And we're going on 10 years now. So you're always going to have people say that we're in a bubble and that there's a 50% market crash coming, right? And this is one of those things where it tends to be a pretty good contrarian indicator. And if everybody thinks that the AI bubble is going to pop soon, chances are this thing might keep going a little longer than you think. And it's actually been funny. You know, we've had weakness in the market and in tech over the last couple of weeks specifically. Mm-hmm. But one of the industries that have held up really well is what? Semiconductors.
Yeah,
these things that power AI.
As a week ago, I saw hitting the index, the sub-index hitting all-time highs.
Yeah. So I just thought it was interesting. Again, I think we go through this every single year at the beginning of the year when people come out and they say, well, this industry is going to suck this year and this stock is going to struggle this year. It's like, if there's a lot of people saying that, then I, again, tend to be a contrarian and take the other side of that. So
I love seeing magazine covers like this. Obviously, I don't want to see the other side of it when there's a lot of euphoria.
Yeah.
And we just got to remember, as investors, you have those two guiding emotions. I want to remind our listeners and viewers, Mark, fear and greed. Fear, when it grips the market, it's in vogue, right? And it's what sells. It's what gets clicks. It's why people buy these magazines. It's interesting when you see these things because let's put a timestamp on this, okay? So we'll have Jenna put a reminder on the calendar 1 year from now. We'll reference this magazine cover, and let's just talk about how the market did.
Yeah. And does this magazine cover indicator bat, 1,000? No, it doesn't. It doesn't always work out like that, but more often than not, it's a pretty good contrarian indicator. So,
you know what my absolute favorite contrarian indicator is the CNBC Markets in Turmoil special. Have you seen that data set?
Yeah. We've talked about it.
I'm not saying I want one of those to happen, but when they do, if you look at the forward returns in the market, it tends to be almost right around short-term bottoms.
Yeah, I don't feel like we've had one of those in a while. So
I'm not saying
hopefully
I want one.
We're not jinxing that, but yeah. Next, I had a post on X from Ryan Dietrich on January 5th. So Ryan said S&P 500 is up 132% the past 6 years. Only 26% of that came from multiple expansion. The rest of it came from sales and margin growth and dividends. This isn't a bubble is our take. It is a bull market being supported by the right thing. So this kind of ties into the first piece that I had. And I want to just talk briefly about multiple expansion for people that aren't in the industry, right?
Our notes are going to merge perfectly. Continue.
Multiple expansion is when a stock or the overall market goes up even when the company isn't earning more money, right? So usually when you see a company's stock price trending up over time, you see corresponding earnings and sales growth with that,
well said.
Right? Stock prices rise because we as investors are willing to pay more for the same earnings, not because earnings grew. So essentially margin expansion is, company stock price keeps going up and up and up and up, but the fundamentals are not supporting that, right? And what Ryan is saying here is that is not happening right now. We are seeing this positive sales and earnings growth and margin expansion, and that's what you would expect when you have the S&P 500, what did I say, up 132% over the past 6 years. You want to see strong fundamentals behind that. So I do tend to agree with Ryan and with Carson that we aren't in a bubble right now. What are your thoughts on this?
Past 6 years, money supplies increased by 50%. People keep trying to tell me that the valuations are stretched. I look right back at them and say, you're giving me a valuation metric on a currency that's been watered down by 50%. Go back to the bar and have a drink, and then we'll talk tomorrow.
Right. So again, this would be a different conversation, and I think we'd have more of a problem on our hands if the S&P 500 wasn't earning more over the past 6 years to support this price growth.
And that's why our notes are going to mesh well, baby. Right. I got a good piece for you here in a bit.
Last thing I had was a blog post from Nick Majuli on November 18th of 2025 titled "The One Thing My Worst Investments Had in Common." So we talk a lot on this show, Matt, about the importance of liquidity in the financial markets. And when I say liquidity, I'm meaning how easy is it or how fast you can buy and sell something at a fair price without moving that price, right?
Yeah, and pause for a second, because listeners and viewers, this is an important topic. I can argue that in my spot here at the firm, I get questions often over the years just about the topic of these types of investments. So listen up. I think Mark's going to share some good information.
Yeah. It's essentially how quickly can you turn an investment into cash or into grocery money, right? Mm-hmm. So when there's a market with high liquidity, there's lots of buyers and sellers. Trades are happening quick. Prices stay stable. You're usually able to buy and sell within a couple pennies of what you want, right? But when there's a lack of liquidity, there's a smaller number of buyers and sellers, and it's harder to trade, and there's bigger price swings when you buy and sell, right? Mm-hmm. So Nick wrote a blog post and says that the worst investments he's ever owned, they all had one common trait, which was that lack of liquidity. And I just want to review a few snippets from this post.
Yep.
So he says, the worst investments I've ever owned all share one thing in common. I couldn't sell them. Whether we were talking fractional shares or expensive artwork or private investments in a friend's company, I didn't realize the paramount importance of liquidity until quite recently. What if I can't sell the investments? What if there's no secondary market for these assets? What's the point of owning 9 square inches of a Basquiat, which is a piece of artwork apparently, if no one ever buys it? Illiquidity can be brutal. I didn't understand this as a young investor. I assumed having more asset classes was always better, having a little bit of everything because diversification, right? And I think that is jammed down our throats so much about having all these different asset classes and all this different diversification that you can get in trouble doing that. And I think this is a perfect example of that, right?
I always prefer the KISS method. You got to keep it simple. I just think there's people out there that love the sophistication of, I'm in this asset class, I'm in that asset class.
Yeah, it's cocktail hour things
Bragging
to talk about, right?
Yeah.
So he continues on and says, but now I'm paying the price for that decision. Owning undiversified, illiquid assets is one of the worst things I've done as an investor. It's worse than just losing money because when you lose money, you know the end result. The uncertainty is gone, but owning illiquid assets, especially those that aren't doing well, is investment purgatory. I have private company shares that are worth more to me as a tax loss than their current value on my balance sheet. Of course, I don't want these companies to fail, but locking up my money for a decade and watching them fail anyway would be the worst of both worlds, though I'd still get my tax loss. I'd only get it after it's been devalued by inflation for a decade. This is why I now despise illiquidity in my portfolio. So I think it's no secret that private investments and alternative investments have gained in popularity over the past 5 or 6 years. We get questions about it all the time. They're popular with other money managers, wealth management shops that do what we do. But like you said, there's a lot of things behind the scenes that I don't think people take into consideration when they start to buy these illiquid assets, right? I don't think you ever want to be in a situation where you're in a cash crunch or you need money and you're not able to sell your asset or investment for whatever you want to, and instead you're taking a 20, 30, 40, 50% haircut on that. So
yeah, my remaining 2 comments is liquidity is not an issue till it is. And once it is, you're not going to get your money out because everyone else wants their money at the same time, right? So you go through a similar GFC type moment, you go through a COVID type moment, and all of a sudden, you're not going to get your money because there's stipulations where the manager doesn't have to. Other thought, people investing into private companies. Some stats I've heard over my years in the industry is that serial investors, people who habitually do it in private investments. Let's go out to California over the last 20 years, and I'm based in San Francisco. I hear the average win rate, if you're good at it, is 2 out of 10 investments.
yeah,
So
that's
8 out of 10,
yeah,
you completely lose 100% of your investment, and you're anticipating that the other 2 will make up for the other 8 losses and some, and you won't see that money for 7, 8, 10 plus years.
right.
I just don't think most people have that patience, have that depth of assets to stay, that illiquid. It's romanticized, but
It's sexy.
realistically, it's not a realistic option for most investors.
Yeah, yeah, or at least for it to be a majority of their portfolio.
Yeah.
Right.
Yeah, that's well said.
So we wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world.
We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
Well, we're going to team up quite well here because I have a piece that caught my eye from Goldman Sachs about Q4 earnings season, which we're in the midst of. What would you say, Mark? We're about a week and a half into it. Is that appropriate?
Yeah. Banks are pretty much done, or the big banks at least are done reporting, and we're going to move our way into tech and discretionary here pretty quickly.
So as we talk about this, I'm going to verbalize what this piece is. Jenna's going to put this up for our YouTube viewers. This will be a good piece within our show notes. Timestamp on this, Mark, is January 13th for the data set. What this piece is about is it shows S&P 500 quarterly, year-over-year earnings per share growth relative to the consensus expectations. The underlying data source here is Goldman Sachs. And what it's showing here is the forecast consensus for S&P 500 earnings are to rise approximately 7% year-over-year for the fourth quarter of 2025. And the interesting aspect of this is where Goldman's seeing earnings per share growth quarter over quarter forecasted for the entire year of 2026. And what you're going to see on this chart is that the forecasted growth in Q1, Q2, Q3, and Q4 of 2026 are all double-digit EPS rises over the previous year. So I'm going to pause there for a second. When I see something like this, if I sit there and I get the comment, but Matt, I'm not seeing the fundamentals keep up with these stock prices. My immediate question is, where are you reading that from? Where are you getting that data from? I'm not insinuating that this is going to happen, that you're going to go up double digits. The point I'm trying to make here is that fundamentals for stocks, specifically earnings per share, for a lot of companies are on a good trajectory. And I think that gets lost in the noise of these day-to-day news headlines that's hitting the market. It's getting people distracted to what the heck's going on in Greenland or what Trump's doing in Davos or, what's going on in Minnesota. And there's definitely good topics to talk about there. But when it comes to investments, you got to think about what's happening in the boardroom of XYZ Corporation. They are great at creating shareholder value if you can be a long-term investor at a lot of these companies, and people lose sight of that.
Yeah.
That's my rant of the day.
Yeah, and I think what's jumped out at me looking at this graph is that the actual earnings growth relative to consensus has always been better than
good observation
expected since 2022. If you look at it,
good observation.
All of the quarters that have had positive EPS growth expectations, the actual numbers came in higher than that. And then when there was expected negative growth, the actual numbers weren't as bad as what people were thinking. So if this trend continues into 2026, that could be really interesting to see where this earnings growth comes in, because Q1 it's at 13%, Q2 14%, Q3 15%, and Q4 18%
year over year for the same quarter
compared to 2025. So those would be some pretty big numbers and bigger numbers that we've seen in quite some time. So
that's why I think the market right now short term is very interesting to me, because the market's been dominated by some of these headlines, and all of a sudden next week you got a lot of these tech and consumer discretionary companies reporting earnings like you mentioned a couple seconds ago.
Yeah.
And every time this tends to happen in the market, it brings people back to the fundamentals. Oh my gosh, XYZ company had that earnings growth year over year. Oh my gosh, you see their balance sheet? Did you see their 2026 outlook? And all of a sudden it makes these more frantic day-to-day headlines less meaningful when you're looking at the actual performance of a company.
Yeah, agreed.
All right, my next piece is with the next Federal Reserve meeting announcement coming up, Mr. McEvely, on January 28th, I wanted to get ahead of that release with an update on what I call the Fed funds rate, how it relates to current inflation figures, and what the market is currently pricing in for potential rate cuts. I want to timestamp this. I did all this work on January 15th around 2:15 p.m. That's important because these numbers change literally daily. Right?
Right.
Okay. So just to level set for our listeners and viewers, take 30, 60 seconds. Mark, what is the Fed funds rate?
Yeah, it's the rate that banks lend to each other overnight when they need deposits. So it's a overnight rate, obviously annualized, and it has influence on other global rates that you and me lend at, get paid on at our savings account, at the bank, et cetera, et cetera.
So that current range of the Fed funds target is between 3.5% and 3.75%. I believe if you drill down, when I was doing it this day, the exact number was around 3.62, 3.63, somewhere around there. So there is an exchange in Chicago called the Chicago Mercantile Exchange, for our viewers and listeners, where they trade these interest rate futures. So right now, for the next upcoming meeting on January 28th, the interest rate futures market is indicating a probability that rates stay the same, 95% probability. Okay? The next meeting after that is March 18th. The probability that rates remain where they're at today, as of January 15th, was an 81% probability. Okay? Next, the meeting after that, April 29th, every 6 weeks. The probability, as of January 15th, that interest rates stay the same was about 2/3, 67%. So, translate it, there's a third chance they could get cut then. Then you go out to the June 17th meeting. What's significant in between these two meetings? You're going to have a new Federal Reserve chair. And so in May, the Trump administration gets to appoint a new one. The probability that rates are remaining where they're at by the June 17th meeting is sitting at 35%. So the market's telling you by June, there's 2/3 of a chance that interest rates are at least lower by 1/4%, right? Last but not least, as you go farther out in the year, I'm going to go all the way to the end of the year because I find this interesting. The dispersion of where the market's at in December is all over the board, right? So you go farther out, the uncertainty increases. So in the December 9th meeting, here's where these stats are. There's a 10% chance they remain where they're at today, a 27% chance they get cut by 1/4 between now and then. There's a 32% chance we have 2 cuts by that time. And then the remaining data set, 20% that we get 3 cuts. I find it interesting that right now, Wall Street, for the most part, is expecting 2 cuts. And the most, let's just say, bought contract is the one that's indicating 2 cuts by year end, which would put the Fed funds rate 3 to 3.25. Last but not least, I want to go over a chart that caught my eye from Charlie Bolello on the same topic, Mark, that overlays the current effective Fed funds rate versus the U.S.'s consumer price index inflation rate. Jenna will have this chart in our show notes. She'll put this up for our YouTube viewers. So why am I showing this? When you look at the lens of history, normally the Fed funds rate would be similar to where the 1-year CPI inflation rate is. Right now, the government's telling us that 1-year inflation in the last report was 2.7%. But wait a minute, that Fed funds rate I just said was above 3.5%. And if you look at some real-time data points that attempt to replicate the consumer price index with real-time data, a research firm I mentioned a couple times in the podcast, Trueflation, they're showing it sub 2%. But wait a minute, that rate's at 3.6%. There is a difference there, and I'll be curious as the year goes on. Do those narrow like they historically do? Or is the Fed seeing economic growth better than people are anticipating, and they want to keep that rate higher? Thoughts, comments on what you're seeing?
Yeah. This is one of the most hotly debated topics in our industry, especially over the past couple of years of where interest rates are going to be, at the end of each year. And I think initially people thought rates would be a lot lower than where they were today. But then there were a couple speed bumps in there and people are like, oh, well, actually they might be raising rates at some point in the future.
Growth's better than we thought.
Again, this is something that changes daily very substantially, these expectations for where rates are going to be. But I think to sum it all up and bring it back to what we had initially said we would like to see from the Fed when they started this rate cutting cycle is the slower and more consistent they can be with the rate cuts, the better. And if we end up getting the 2 cuts that I think the market expects in 2026, I think that continues to follow that plan, which should be a tailwind for stock investors.
Just to take it just one step further for 30 seconds, in the lens of history, when you look at forward-looking returns for the stock market, the slower the pace of cuts in an interest rate cutting cycle tends to deliver higher rates of return for risk assets, including stocks. When you have a Fed that is quickly cutting rates, I always use the patient analogy in a hospital. They're trying to pump that patient full of medicine at a quicker pace. That means the health of that patient is not as good. It's my analogy. My last piece I want to talk about is a piece from Charlie Bolello again. The date on this one was January 17th. And he shows the S&P 500 total returns, and he has the data set mark 1928 to 2025. And he shows the difference between the average up year for the stock market and the average down year for the stock market. And what you're going to see here is since 1928 to now, when the market is up, the average return in that year is 21%. And when the market is down over those data sets, the average down year is down 13.5%. I thought it was a good piece because obviously most people think, well, depending upon when you look at it, stocks averaged 8%, 9%, possibly even double digits depending upon when you would look at the trailing returns. People are programmed to expect if it's a positive year or that should be my average every year. Doesn't work that way. Your thoughts and comments?
Yeah, I think that there's, again, this misconception among investors or maybe newer investors that, hey, the stock market owes me X percent return every single year. And that's just not the way that markets work.
Correct.
Right? It could be your first year investing and the market could be down 30%.
Yes.
And maybe you have a sour taste in your mouth about that, but that's just how it works, right?
Yes.
So yeah, very, very interesting. And obviously the average returns over the past decade have been a lot higher than the average returns since the market's inception.
Well said.
So again, you have more people out there calling for, sub 1% returns for U.S. stocks going forward for the next decade.
They said that 10 years ago, by the way.
They did send that 10 years ago, and look what we've had over the past 10 years. So
my other favorite over my career is we're at peak profit margins. Profit margins cannot get any better, Mark. There's nothing that they can innovate to increase profit margins.
Yeah, I moderated a panel this summer and last summer, or this past summer in 2025 and in 2024, and I think we talked about peak profit margins both times, and we're still on the rise seemingly. So,
Jeremy Grantham at GMO's on the struggle bus on that one.
So, yeah, really, really good piece. I wish this was shown to every investor out there, just to kind of temper expectations.
That's why I wanted to have it. We got to remember we're going to have down years. We're going to have down months. We're going to have down quarters. That comes with part of investing in this asset class.
Yeah.
Right?
Right.
Final comments for where we're at with the calendar before we invite Taylor onto the podcast.
Yeah, I think, the performance of the market over the next week is going to tell us a lot about potential future performance for the rest of 2026. So it's, something that we look at called the January Barometer, developed by Yale Hirsch, famous for his saying, so goes January, so goes the year. Like I said earlier on the show, S&P 500's up a little less than 0.5% so far for January. obviously a lot can happen between
Sure.
now and the end of next week, but if January is positive, then it increases the chances of having a better year, I would say. So that's one of the things that we're looking at. And then obviously later into next week and early in February, we're going to get a huge slew of earnings reports from a lot of these big companies that we track.
Well said. We'll get a jobs number for January, the first Friday of February. And a lot of eyes will be on that data too, inflation data. It's going to be interesting.
Yeah, it will be. So I will leave it there. I'll slip out and have Taylor Ledbetter come in and talk about the financial planning topic of the week.
Wonderful, Mr. McEvely. Thank you, sir. So next up on the podcast, we do our financial planning topic of the week. Taylor Ledbetter, she handles all of our financial planning needs here for the clients at Jessup Wealth Management, fan favorite. Taylor, welcome to the podcast.
Yeah, it's good to be back.
What's on your mind right now? What did you come for our listeners and viewers this week? What's the topic?
Yeah, so today I'm going to be referencing an article from a website called The White Coat Investor.
Okay.
And it was titled Myth versus Reality, Rethinking Common Financial and Lifestyle Assumptions.
Okay, I'm in.
All right, so the first myth or misconception we'll talk about is estate planning is only for the elderly or extremely wealthy.
How many times do we get that, Taylor?
I get a lot of questions about
Yeah,
this.
right?
Yeah, people will think that just because they're young, they don't need any estate planning documents.
That's right. And so many times I sat down with a prospective client yesterday morning and their elderly parents didn't put beneficiary designations on brokerage accounts. And the hassle factor of settling that, people just don't really realize. Keep going. This is going to be a good one.
Yeah. So I just wanted to talk about, multiple reasons why you should have these in place. I think the most obvious reason is that you want to make sure your assets go to the right people. So kind of what you just said.
Sure.
But there are several other reasons to have them in place. So another reason is if you have kids in your will, you can put a guardianship clause so that you choose who would, take care of them once you or the other parent was gone. So that's very important to have because otherwise, the probate court or the court in general just decides
Yes,
who's
and
in charge.
I remind people we can't legally draft these documents, so we bring in outside legal counsel that can do that. But I do remind clients that individual you name doesn't have to be a blood family member, right? So I think there's a lot of misconceptions as you drill down on that topic, but it is an important decision that parents have to make.
Yes, absolutely. Another reason is simply just family harmony. Kind of what you just insinuated, when you go through the probate process, that could take 6 months to a year, maybe even longer. It really just depends.
Yeah.
But that's just a lot of stress on your family, could cause family arguments.
Yes.
So it just makes everything easier on them.
Another topic that comes into play is pets. People have to plan if something happens to them, how their pets are going to continue to be cared for. And that's another aspect. Let's just take my life example. Our office dog, my dog that comes home with me, Louie, important part of the family. We got arrangements. If something happens to Rachel and I, like who's going to take care of Louie, right? And there's a lot of people where their pets are family, and we got to make those considerations.
Yeah, that's another good reason. See, I didn't even think about that.
Yeah. so those are
yeah.
aspects we got to think about.
Another reason, and this is for, anyone who's really 18 and up. So when you do turn 18, your parents don't have access to medical records. They can't make financial decisions for you anymore. So it's really important to have a healthcare directive or a financial power of attorney. If you're, let's say, college age, you probably don't need a will yet because you probably don't have any assets. But on the medical and financial side, that's really important.
I usually recommend this when kids are going off to college, quote unquote, you want to have these documents in place.
Yeah,
Right?
even if they live at home or you support them.
Absolutely. These medical professionals obviously take HIPAA laws very seriously, as they should. And these documents need to be in place, right?
Yeah, and if you don't have them in place and you need them, it's a pain.
It's an uphill battle.
Yeah.
Right?
All right, the next myth is everybody needs whole life insurance.
See that one often in general.
Same here. So the article said that insurance agents are very skilled at selling fear, but the need for permanent life insurance is not universal.
I love the way that sentence is said. That's very accurate. That's very correct in my opinion.
I agree. If you have enough saved for your dependents, you may not need additional coverage. Term life insurance is appropriate for those in the wealth building years with young families.
So my rule of thumb for most families is as follows. Most people are way underinsured when they're younger, and they tend to be way overinsured when they're older. And getting that stuff right-sized is a hassle. Let's just face it. Getting life insurance is a hassle factor, right? Mm-hmm. It's a necessary evil. And you can get it through your employer, you can get it on your own. But again, younger families, specifically if you are in a relationship and or you have children, the need for that insurance, in my opinion, goes up dramatically.
Yeah, absolutely. And even if you don't have financial dependence, if you have fairly large liabilities,
well said,
maybe not a lot saved, that's another reason.
To compliment you, Taylor, on some of the work you do for our clients and prospective clients behind the scenes, it's not uncommon that you would do some sort of a life insurance needs analysis where you can tell that client, hey, on paper, based upon the income that you're making and the responsibilities you have in life, this is an appropriate amount of insurance I feel you should have at this point of life. And those are very important calculations. So if you are listening to this and you're wondering what that might be for you, you can reach out to Taylor. She'd be happy to run those calculations.
Yeah, good point. The next myth, which I also hear pretty often, is I'll run out of money in retirement.
Yep, we hear that a lot, right? Or it's a concern.
Yes, it's a valid concern.
Valid
I understand
concern.
it.
Yep.
But the article goes on to say that the financial media and some advisors do fuel this anxiety, suggesting that you'll need $5 million, $10 million, or more to retire safely. But most people overestimate their true needs. Our longevity, despite modern medicine, still averages between 70 to 80 years plus or minus a decade.
It's accurate. I tell people, boots on the ground, we are seeing our client base longevity is above the averages. I would argue that. Is it just because of where we geographically live? Is it just the lifestyle of our clients? It's hard to say. But when it comes to this standpoint, having a relationship, whether you hire a professional money manager or you manage your assets on your own, monitoring your withdrawal rate over time in retirement for the longevity of your nest egg is definitely an important topic. And that could be a whole podcast within itself, right, Taylor?
Yeah. All right, the last myth we're going to touch on, and I think this one might be the most popular.
Ooh, I just looked down. It's going to be a hot take topic.
Is that Social Security will go bankrupt.
How many times a month do we have conversations about that topic within itself? Amongst anybody else at the firm.
I get it very often, and it's because, the federal or the reserve fund for Social Security is supposed to be depleted by 2033, 2034.
I argue the next presidential election cycle in 28 is just this will be one of the top 3 topics.
Yes.
In my opinion.
And I personally don't think Social Security will go away. Maybe there will be some changes.
Keep going.
How the Social Security system works now is that all the benefits that are currently paid out to retirees is the money that's currently being paid in from like a W-2 employee, for example.
Yes.
So people are going to keep working and paying into the system.
Yes.
So money is still going to be pushed out, after 2033, 2034.
Yep.
But let's say, there's absolutely no solution until then, and that reserve does run dry.
Yes.
Your monthly benefits might just look a little bit different, but they're not going to halt.
Last I looked, and you might know more than me on that specific topic, it's a run rate of somewhere in the 70 cent on the dollar range is what they're projecting to take in versus the benefits they're paying out in the mid-2030s. Does that sound right to you?
Yeah, I've heard 70 to 80,
somewhere in there. So it translate that just even more direct and transparent. If there's no congressional changes to this topic and those forecasts remain the same, if you're getting $1,000 a month and all things are equal, you'll get between $700 to $800 a month and a reset in the 2030s.
Yeah, that's a good way to say it.
That's a good way of saying it?
Yeah. And there's, I think that they'll find or try to find some type of solution.
Yes.
They'll try to do something.
If I had to speculate, I still feel, in my opinion, that we're going to go to more of a needs-based calculation, similar to how Medicare premiums are calculated based upon someone's income, to where higher income earners, for better or for worse, might get an adjustment to what they receive. Might not be a popular take. It might be a popular take with others. That's just where I think eventually the puck is going.
Yeah, no, that would make sense to me too.
Yeah, would that make sense?
Mm-hmm. Well, those are the main misconceptions I wanted to cover today. So I thought those were really interesting, just questions we get pretty frequently.
I like it. And going back to the estate planning, I feel a lot of people try to avoid the topic, Taylor, because no one likes talking about mortality, right? It's not a fun thing. And I feel that the lift of anxiety and stress, once somebody puts that to bed, doesn't mean you can't revisit it and update it at a later date. But the lift of anxiety and stress, once someone completes that process, they always come back and usually say to me, wow, I wish I would have done that sooner.
Yeah.
It usually is the message. And I just want to leave our listeners and viewers with that thought, because the thought of doing the planning is very unattractive, not appetizing.
It's like an uphill battle.
It is an uphill battle, but
it.
once you get it done, it is a good feeling. It's a good feeling. Final thoughts, comments, Taylor, before we sign off?
No, nothing else for me.
All right. Don't forget, we're in the midst of earnings season. If you're seeing volatility, listeners and viewers, on some individual securities, it might be because they just reported earnings. So thank you for listening to episode 335 of the Independent Advisors Podcast. Catch us next week for episode 336.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.